Good afternoon and welcome to the Investing with IBD podcast sponsored by Scoofus Capital Management. It is Justin Nielsen here and it's September 28th, 2022. And as always, I have Arusha Peiris, portfolio manager at O'Neill Global Advisors, joining me today. How are you doing, Arusha?
Hey, Justin, I'm doing great.
Very good. And you know what? We're going to get a little bit of we time today. We're going to go over the market and kind of talk a little bit about what's been going on the past week. Also, get into a little bit of a learning lesson, how to stop the chop. And then we'll cover some of the stocks that are on our radar. And maybe we have a special guest appearance. We'll see. But let's go ahead and start getting right into it. You
And
want to
Justin,
start?
well, before we get into the markets,
Okay.
I think we owe all the listeners to know the good news that it is your 25th anniversary at IBD. So
Yes,
congrats.
yes, it was last week. Last week I was actually at the New York event that we had with Market Watch, and we were doing the IBD live from there. I did the podcast from a hotel room. Had to do it on a window ledge to get the lighting just right,
Yes. Yep.
and so yeah, that was the day. So 25 years. It's incredible. It's been quite a run, but
Eh,
and especially since it was only supposed to be 1 year and that 1 year turned into 25. I guess I don't have much discipline in that regard. So, not really sticking to my guns. Okay, with that being said, how about we take a look at the market? Nasdaq Composite had a really strong day today. I mean, all the indexes were looking pretty good in terms of how they finished, right up near the top of their ranges. But that was a pretty ugly week last week. I mean, after we taped the podcast, things just got worse, and it really seemed like a lot of the leadership was taken to the woodshed. They were coming after everything. So Enphase, ShockWave, Celsius, all the things we had been talking about, like, oh, look at how this is holding up. They just all got whacked, and now here we are. We're looking at a lot a lot more destruction has happened. The S&P 500 undercut its lows, its June lows. The Dow Jones Industrial Average undercut its June lows, but the Nasdaq has held up along with the Russell 2000. And as bad as Friday got, the Nasdaq Composite has been able to stay above that Friday low that we had last week.
Yeah, so it's day number two, right, of an attempted rally. It is positive that the Nasdaq hasn't undercut yet. I think in many ways, if the market can hold, it's a positive that the S&P undercut, right? Because you
Hmm.
do have a little bit that shakeout, and
Right.
a lot of times you want to see an undercut. You want to see fear coming into the market, so everyone who was going to get out is going to get out. So that is a positive. We have been selling off for quite a while now, what, 5, 6 weeks. But I think you have to be cautious. You have to take it very slow. We're still in a correction.
Hmm.
Still day number two on the Nasdaq. So the earliest we could get a fall today is Friday. So if we
Hmm.
have another day like today, where it is a powerful day on higher volume, we could get that market signal. But that being said, really, are there a lot of stocks out there that are building bases and really setting up? It's still pretty thin, but I think the big thing is keep an open mind. Know that we could get a market signal on Friday, and if that happens, then you look for something to buy and place a small position in and see what happens. Get a little bit of feedback.
Yeah, absolutely. I mean, it seems like, I mean, we've certainly been talking about how it has gotten to a lot of indicators have gotten oversold, and it seemed like a bounce was imminent. And look, I mean, we did get that bounce kind of at the end of, end of August, and it seemed like that could have maybe had some traction there. But I mean, it was 4 days, right? And then we were right back to plunging. I also want to kind of address a little nuance here when looking at the Nasdaq. We have this day. Oh, actually, did you want to cover some of those market
Yeah, yeah.
indicators
If you want, why
since
don't
you
you
had
go
it
over the
up?
Nas? Yeah, why don't you go over the Nasdaq and we'll go back to the market indicators.
Okay, okay. So just a real quick little nuance here, because a lot of people were asking, and I was actually asking myself, what did we do with a pink rally day on Friday? This is something that when Mike Webster, Charles Harris, and I sat down with Bill O'Neill, and we were coming up with these market school rules. We kind of came up with an automated way of attacking the market indexes. And, we did have a number of these days where day one of the rally was not a day that ended up for the day. It wasn't a higher close from the previous day. There were these days where it closed down, but a lot of progress was made. A lot of times the spread tended to be a little bit wider, and a lot of progress was made off the lows. And so we had noticed, Mike, Charles, and I, when we were going through the How to Make Money in Stocks book and the market section and some of the different areas that Bill had chosen, we noticed that there were a few of those that it was a pink rally day, where the day that started the rally was actually a day that closed down. Now, Bill said, hey, this has got to really close up off the bottom. And again, it usually was a wider spread, but we wanted to make sure we weren't being too restrictive. So we basically said, okay, you know what? We'll take a half. If it's in the upper half of the range, we'll accept it as a pink rally day. But then the question gets, asked, what if there's a gap down? You see a day like we had on Friday of last week, and if you consider the closing range of what the index did that day, just using the high and the low, well, it closed in the 60% range. So it would qualify as a pink rally day. But if you considered that the gap down, where it came from on Thursday, then it closed in the 40% range. And so I had to actually look into my code that I did, and we did make the decision to not count things that were in the lower half of the true range. So that's why, to your point, Arusha, this was day 2 and not what could have been a follow through day.
Yeah. So the pink rally days it's an interesting concept. Now I think I think you guys talked about this in the market school courses years ago, but for the pink rally days, it gives you sometimes it'll give you a little bit earlier entry, but for all of those rallies that ended up really working, you had another follow through day shortly afterwards.
Mhm.
Right.
Or the pink rally day didn't matter. You had
Right.
enough
Okay.
days,
Yeah.
whether if you use the blue rally. So it wasn't like we wouldn't have called this follow through at all,
Got it. Okay.
because, most of the time it just didn't matter.
Yeah.
You got it with the blue rally.
Yeah. So it's interesting because like a lot of times, because there were always, before you guys did the market school study, uh, I think there were only a few examples that Bill highlighted of pink rally days, and it was really kind of like market was really selling off, and then halfway through the day it came all the way back. So maybe the market was down like 2%, and then came all the way back and finished up 1%. And so you had this like really big bar, but it was still slightly, or maybe didn't finish up, but it finished slightly down, like but right at the high of the ring. So it was kind of like this big hammer, but it was a
Yeah.
down day. And so that's what it's kind of always like in the back of my head when I'm looking, like, or I'll notice of pink rally day, those type of days. These more subtle ones, like for instance on September 16th, on
Right.
that day. So I'm lucky enough to be in a kind of a daily call with a few people, and Charles is one of Charles Harris is one of the people on it, and a lot of times he'll kind of just give his market thoughts. And so he identified that the September 16th as a pink rally day, and it didn't really register. It didn't really pick up for me because it was just such a small day, but it
Mhm.
did, according to the market school rules,
Yeah. It
qualify
did close.
for a pink rally day.
Yeah.
So yeah, so it's good to know those little details there. Uh, but when we have like kind of that real market signal where it really leads to a great rally, you're going to have multiple follow through days, and a lot of times, as you said, Justin, it's not going to necessarily matter.
Right.
But there are going to be some of those instances where it is going to give you a little bit of an early head start. But I think the bigger thing is that you always want to, even though we're playing defense or not, we're being cautious. You always want to be ready to go back in, right? You always want to have that optimistic mindset.
Right.
And we sold off a long time now, right? We're near the lows. Though this
Mhm.
market could turn, right? We had
Mhm.
a pretty good rally in July, and it was a short 4-week rally. It was a counter trend rally as we thought it was most likely going to be, but it was still a pretty strong rally. But there's going to come another one like that where it starts off strong, and you're going to think it's a counter trend rally, and then it's going to turn into the real rally. And so if you don't take all of these falter days at face value and seriously, you're going to miss out on kind of that first leg up. And a lot of the best stocks,
Right.
if you're just kind of waiting for more kind of information come in, or more for yourself to get more confidence in the
Yeah,
market.
that's usually what it is, right? You're waiting for that confidence to come in, and it's like, yeah, by the time you find, by the time you finally are reading headlines that are saying the bull market is back and the bear is over, well, then I mean,
Right.
you're months into the thing. You know what? I did want to just address one more thing about the pink rally day. If you could go ahead and go to the S&P 500 and just change the date to 1982, and I will show you one of the examples where it did matter. You can see how the market came down, and again, this was a pretty brutal correction that had lasted for a while. And there's your pink rally day right there for those people that are
Yep.
watching at investors.com/podcast. We're looking at the day of
So that was August 9th,
August
1982.
9th, yes. And this was a really unusual situation. You actually didn't have much of a rally
Yeah.
happening. Each day kind of was, trying to make progress, trying to make progress. The low held, but it wasn't until 4 days later that you actually got an up day. And then the day after that is when you got the follow through day. And
Yeah.
even, oh no, I'm sorry, 2 days after that. So
Oh,
you got the follow through day.
it was over here on like
Um,
August
no,
23rd. Or...
on the 17th of August. Yeah,
Oh
there you
yeah.
go. Yeah,
Okay. So that's
up
where using the
4%.
pink rally day.
Yeah. So,
Yep.
and again, if you had been using, if you had said, "Oh no, I need a blue day," well, that would have only been day three, um, and we
Right.
wouldn't have called that a third day follow through day because the middle day was just not powerful enough. So yeah, the pink rally day mattered there. It's one of the few cases where it did, but this is one where it was an example that was in how to make money in stocks. And so we, we kind of went to Bill and said, look, we just want to get a little bit more insight on this and why you counted this one, and of course this is what started one of the greatest bull runs of all time, right?
Yeah.
This
Yeah.
is when the inflation was really truly the back was broken of inflation. The rates were starting to come down again, and the growth was just phenomenal from that August 1982 follow through day.
Yeah. Now I think the key is you take all the fall through days seriously,
Hmm.
but you don't go too aggressively, right? You put a position in if you see a great stock breaking out, but let the stock prove itself before you start putting more and more money. Because if you're too optimistic or you're acting on too many falter days, especially as we've seen this time around, this next upcoming falter day, I guess, will be the 6th of the year. You're going to get chopped around, right? You're
Yeah.
going to give too much back, and if that's the case, you're going to lose a lot of valuable principal, and
Mhm.
you're going to be gun shy to really try it or really move into the market when it's actually working.
Yeah, and that's one of the worst things it can do is psychologically damage you a little bit. But before we get into that, because we're going to get into that more on the next segment, let's go ahead and circle back to those market indicators. You brought them up briefly, and I thought it might be a good time to go through some of those market indicators. For those of you that do have MarketSmith, you can get to this by typing in the symbol NASDQ. This gives you these daily market indicators. And what are some of the things that you look at on this page?
Honestly, though, the one thing that I'll look at, I don't look at it too often, but when the markets are selling off, I'll pull it up just to see how oversold it got. And
Mhm.
so it's really the second graph, the short-term overbought, oversold indicator. That's what I'm going to look at. And in January we hit, and this I think this came. I think Charles talked about this one time where we hit lows that hadn't hit
Unprecedented,
lows like in like
right?
20 years or something. I mean, maybe ever,
And
and
that was
all the
so
data we
quick
have.
too.
Yeah,
Yeah.
yeah.
Mhm.
And that was one point where he was becoming more bullish. And when I saw that, I was like, yeah, that makes a lot of sense. But the problem is that a lot of times in weak markets, markets can get oversold and stay oversold.
Mhm.
Right. And so that's one thing. When they become pinned, that's not necessarily a good thing. A lot of times it means the market's just so weak that even the oversold indicators aren't working. But it's been a long time since then. It's been a lot of chop, and so we're pretty close to that range again. So you just want to keep an open mind. But I think it always comes down though to the stocks themselves. Underneath the surface, how many stocks are setting up? There we have a handful of stocks that are still hanging in there. But the reality is that there are a lot of other stocks, when you look at them, they just need more time. They need more time to build the right-hand sides of bases and attempt to break out. So it's we're not in that sweet spot yet. But if we get the follow through day, you might have a little bit of merchandise to try. And then the other one that I'll just take a look at a little bit is right here, the last chart, where just the new highs and new lows is a 10-day moving average, and you can kind of see the new lows are starting to increase again. They came all the way back down,
Right.
Where the new lows have been like kind of leading the whole year, but around August, when middle of August or so, it actually went. The new highs actually briefly took over. But now the new lows are starting to creep up again. So that's just showing you underneath the surface there are more stocks struggling.
Right. And it's also one of the things that was interesting about today, at least. Apple was certainly weighing on the indexes. I mean, they were kind of saying that they were going to have production issues because of demand, and I mean it was down more than 4% at one point. And so, with Apple being such a huge part of the S&P 500 and the Nasdaq 100, Nasdaq Composite, because they're market weighted indexes, you just were seeing this kind of drag. Now, Apple ended up closing down just 1.3% today. But what was interesting is we were looking at this on IBD Live, and sometimes what I like to do is I like to pull up QQQE, which is the equal weighted of the Nasdaq 100, because sometimes you'll kind of see a disparity, right? If it's the market cap, the heavy mega caps that are driving either the up or down action, you might see a big difference between QQQ and QQQE. In the same way, sometimes I'll also look at SPY versus RSP, which is the equal weighted of the S&P 500. So just one other little arrow you can put in your quiver, to kind of get a sense of what's really happening under the surface of these market indexes.
So what did you see anything in the QQQE today when you were comparing it versus the QQQs?
Oh yeah, I mean at one point the QQQE, the equal weighted, was up 1% when the Qs were actually flat or down.
Wow. Okay.
So there was a big discrepancy, and even I mean the way that they ended today, the Qs were up, pretty nicely, up 2%, but QQQE was up 2.75%. So still had a lot of outperformance there because some of those mega caps, I think, were dragging it down a little. So anyway, you know what? Let's go ahead and let's take a break right now, and when we come back, we'll get into a little bit more of this whole concept of how to stop the chop. Stay tuned. We'll be right back.
Peter Skoufis, founder of Skoufis Capital, has successfully managed money using Bill O'Neill's strategy for the last 17 years. Peter's missed major market crashes, such as the financial crisis of 2008 and most recently the coronavirus crash of 2020. One of his strengths is finding new leadership in new market uptrends. If you would like to talk to Peter and get his thoughts on the current market and what to do now, or get a complimentary review of your portfolio, feel free to contact him at skoufiscapital.com. That's SKOUFIS Capital, CAPITAL.com. And fill out the contact form or by calling 866-562-2634. Protect your capital and don't miss the next market uptrend.
Okay, welcome back to the Investing with IBD podcast, sponsored by Skoufis Capital Management. It's Justin Nielsen here, along with my weekly guest, Irusha Peiris, O'Neill Global Advisors Portfolio Manager. So, Irusha, I think when you get into a downtrend, and this has been a little bit more prolonged, right? I mean, it's not the V-shaped COVID recovery that we had, where it's by the time we hit bottom, it was a month into it, and a month later we're screaming out of it. This is a lot more prolonged. This is where the destruction can be a lot more, and there's all of these false rallies that can happen, these counter trend rallies. And we went over this. We went over, how many different rallies there were in 2000 to 2003, some of them very powerful, including a 40% rise in the NASDAQ after September 11th in 2001. So you did have these powerful rallies, and we've seen that this time too in March and in July, where it seemed like we were starting to get some traction, but we ended up coming up to resistance, hitting our head on it, and getting turned right back down. So I guess the question is, what are some of the ways in order to kind of protect yourself? And again, the psychological part is important here, but how do you stop the chop?
Yeah, I think I think the first question that I generally ask myself, and a lot of people asked us over the years, is can you stop the chop,
Yeah.
right? And still, be get in the market at somewhere near the lows. I don't think you can. I don't necessarily think you can completely avoid the chop. You have to put a little money to work when you get those signals. Uh, that's the biggest thing. You really have to put that money to work and get some feedback from the market.
Mhm.
Now, so you are going to get if in these really choppy, tricky markets, you're going to give some back. The key is not giving too much back. That's why you want to play really, really small. And so a lot of times what I'll do is, like, so I'll tell what I've done this year, right? So I started out early in the beginning of the year, like 5% positions.
Mhm.
Right, and those got whacked, and so then I reduced it to like 2% positions. Then I started making a little bit of progress and went back to the 5%. Now I'm down like to 1% positions,
Mhm.
right? Because my 2% positions that I tried a few weeks ago, they started blowing up, and so now I'm down to 1%. I'm not trying to make money at this point. I'm trying to get traction in the individual, the 1 or 2 positions that I'm taking. I want to just see some progress. Now, going back to the fall through day that we had in beginning of July or end of June, that
Mhm.
ended up like a 5-week rally there. Uh, all the little positions I took, and those around 5% positions, and I slowly started scaling those up. They actually made some progress, right? They were it was weird. It was like, wow, they're not getting killed. So that was giving me feedback that we might have a chance here. But once they started selling off, you back away. So it's that process of actually putting a little money to risk, not a lot, to slowly get that feedback, because we know using our system that once we kind of see the traction, once we start seeing the stocks moving, we can quickly move into the market, right? We can get into that next stock that's breaking out. We can scale up those positions to, once they're really working, you're going like from a 2%, 5% position to a 20% position, right?
Right.
But you're not starting off with a 20% position, starting off with a 10%, then you bring it up to 6, add 6 more percent to it, and then finally 4. So you're scaling in that way. But at a beginning of bull markets, and when you're in strong markets, a lot of times we're going to have 5 positions, each of them 20%, right? So we know we can make a lot of the ground that we might have missed by not being there at the bottom pretty quickly in strong markets, because we're gonna really kind of make up for that with stock selection and concentration.
Yeah.
That's kind of the key. That's why I think it gives us a little bit of a luxury of play small, and then once you start seeing the traction, market starting to work, start the stocks starting to work, then you become more aggressive.
Mhm. And it's as you said, it's feedback, right? The market is giving you that feedback that you're making good decisions, that you're getting that traction, and that's what allows you to get more aggressive. But certainly, I'll tell you where I was 25 years ago, and I know I've shared this story. First of all, it was such a strange time to start, because the late 90s, it was like you could throw a dart and everything was going up, right?
Right.
So it was almost like you think you're a genius, especially when you're a young punk kid, fresh out of college, just learning about the stock market, and you think you can't do any wrong. But then you get a situation like 2000, 2003, where I was so eager to make that money and get back to the late 90s, where it was so easy. I kept on going in hard each and every one of those rallies. And I would be on margin within days.
Yep.
And that's a real easy way to get chopped up. And what was the worst part about it is I got out so good in 2000. I went to full cash in March of 2000,
Wow.
and was just patting myself on the back of how awesome I was. But then by the time 2003 rolled around, I had I disintegrated my account by 50%. It was over 50%. Now, the good news I had so little money at that time. It wasn't it wasn't like I lost a huge sum, but still, percentage wise, I'm glad I made that mistake early and not now.
Yeah, you bring up a very good lesson right there. I mean, if you're new to this, especially to the methodology here, you have to play small, play very small, because the stocks that we end up playing in, they move up fast, they move down a lot faster. Now, getting back to you, kind of that other statement that you said, Justin, with when markets are strong and you think you're a genius, right? It's not really you at that
Yeah.
point, right? It's the market. It's the same way. If you got caught in this bear market, and we've all gotten caught in them. I got caught in that 2000 bear market that Justin was able to avoid, but I learned my lessons, and I've been able to kind of manage not getting crushed in these other bear markets that we've had since then. But the key is you're not that bad when in the bear market. It's not like you're an awful stock picker, or you're just know nothing, right? You're just in an awful market. No one it's very, very difficult if you're trying to go long to make money in a bear market, right? A lot of people will ask us, oh, why don't you just go short? Well, for me personally, I find it a lot harder, right? So a lot of times I just prefer not to play. If I'm going to go short, I just play very, very small on it.
Mhm.
I'm never going to go aggressive, even though you look back and go, man, I could have done really well going short. I knew that this market was in trouble for a while. I should have just gone the other way, but I've always found it hard. So I generally just kind of stay more on the sidelines and just wait. So that's up for everyone to kind of decide for themselves. But shorting is, I've found, much harder than going long. But I think the big thing is, you want to kind of learn from this and know that in the end, it's the market, right? And so it's up to all of us to listen to the market. And that's
Mhm.
what these small positions, when you put them on, you're just getting feedback from the market saying, okay, is the environment changing or not? And it's going to tell you that just by, are you making progress in your portfolio or not?
Right. And there's a little bit of patience that's required,
Yeah.
especially for folks that have had some success in the market. And I'm sure this happened to a lot of folks that started in 2020. You're like, wow, this is awesome. I'm making money, and you start getting to a point where it's a sizable sum that you're making, and when that's kind of taken away, it makes you sad.
It's awful.
Like
It's awful.
you want those good times back. And but there's two things. Now, one of the first things that happened, I feel like, with some of these rallies that we were getting this year, is that there were no stocks behind them. A lot of times what was happening is you were seeing a lot of the bottom fishing, right? It was your upstarts, your Shopify's, your stocks that were down 80%, that were just bouncing off the bottom. Those were some of the ones that were driving some of these rallies, these false rallies. And that's not our style, right? It's not our style
Yeah.
to get into those bottom fishing type stocks. And so it was really easy to kind of sidestep some of those false rallies. What was a little bit trickier is now we've seen a lot of these names kind of have this much better relative strength. The indexes are below their 50-day and 200-day moving average lines, and you start noticing the stocks that are holding up above their moving average lines, or even making, they're close to new high territory and forming bases. That's where it can be tempting. But to your point, it's that feedback, right? If you're picking the right stocks, and a lot of people would say this has been a stock pickers market, right? If you're picking the right stocks, you can make progress. But if you're in the wrong stocks, uh, or the market itself, it's been pretty terrible. So you've got to kind of use that feedback mechanism. And I think that patience level too means don't feel like you have to be getting in at the very bottom. We don't we don't buy at the very bottom and we don't sell at the very top, but there's a lot of room in between there where you can make a lot of money. Um, just by being kind of 80% there. You don't have to get 100% of the move.
Yeah, no, it's ego, right? A lot of times you just gotta be able to walk away and say, it's not my time. This is not my environment. And that's okay. You don't always have to try to make money. There are plenty of times where the right decision is to stay on the sidelines or play really small. Some other suggestions to kind of avoid the chop or really stop the chop in many ways is, and this is something that I learned from Scott St. Clair, take a bunch of money out of your account. Scott's always been very good at that, where
Charles does that too.
And Charles does that. Yeah. So it's like a number of these guys who have done really well have been able to, be able to keep most of their money, right?
Mm-hmm.
It is they will just literally take the money out of the account and put it in their bank account, just take it out of the trading account so they're not tempted. So now you're playing with a smaller amount of money. And so now, even if you go 100%, you're just really a 10%, maybe,
Right.
So they're like taking 50% of their money out, maybe even more than that, right? So I think that's another good suggestion. If the markets are tempting you, if it's calling you, when you have those quotes kind of constantly flashing, you feel like you have to do something. Yeah, I think that's another thing. In bear markets, when markets are really tough, I try not to watch. I try not to watch the quotes too much. I'll put the charts to weekly charts. And so to try to, because all those little signs, especially when you're looking at the quotes, all those little colors flashing, those are triggers, right? They make you itch. You really want to do something, and you get that urge. So I just try. I cover the quote screen. I put something else on there, or I walk away from the computer. I go, I kind of stay away from the computer and go and read or do something else, and focus on some research or some stocks or some trends or whatever, but not watching the screen because I know the market is bad and we're a few days away from a fall through day and all that kind of stuff. So I think those are a few things to do. But the biggest ones, the feedback. But I think the other thing is just realize your emotions, right?
Yeah.
You have to know that you're going to get emotional and you have to learn to manage that.
Do you ever scream at your screen and just say, "Leave my dopamine alone"? Like, I know what you're trying to do.
Honestly, I'm happy to say that I'm past that where I really start screaming and all that kind of stuff. I don't have too many of those kind of episodes anymore, which is good. Which is not, but that's experience, right?
Yeah.
Like a lot of times the highs you can put, like when you're doing like 2020 when we were all doing well, we could kind of put it in perspective, saying, this is acting too well.
Right.
We're not this good, right?
Yeah.
It's like we better start figuring a way to lock in some of these gains and keep this money, because this is one of these once in every 20 years type of events. And then the same time when you're in a bear market and everything you try just fails, like, I'm not going to get too down on myself. I realize the market's changed, so I'm just going to go smaller and just kind of try to keep most of the money that I have right now, and just wait. It may take. Did we know that it's going to last this long? No, I thought that by now it would probably be getting pretty close to changing, but we don't know. Maybe we do get a fall through and it changes this week, and maybe the next great bull market starting next week, or it might be next year, right? So we just don't know. But I think the biggest thing that we all have is, and the biggest advantage we have using this methodology, is that once you see these signals start coming and you just start seeing, and we saw it in July, you saw a number of fall through days start happening, right? I mean, that was kind of a good little preparation, I think, where you saw a number of fall through days happening. You saw a number of stocks working well. It just didn't, and the rally worked a little bit, right? It went up like 15%, 10 to 15%. So that was kind of a good practice. There's going to come another time where you start seeing that again. And so you just let the market slowly pull you in. So that's what I've always had over the years as kind of my safety net, that I know that I'm not going to really, knock on wood, but I shouldn't miss, anything's possible. I definitely could miss the next rally, but I shouldn't miss the next rally because there are enough signals there to keep giving you reason to get exposure in the market when the time is right.
And a lot of those, as you said, you're dipping your toe in, and eventually, you start getting to a point where you're like, oh, things are really moving, and I need more exposure so I can participate in this. And again, that's where things start cooking. Of course, I think it is important that people do keep that perspective in mind. As you said, 2020 was one of those very unusually strong time periods, and you can't look at the next rally as necessarily being the same as that, right? I mean, we had a Fed behind us, stimulus money, liquidity, going crazy. That kind of created a perfect storm. And so don't be surprised if the next time, you're not making 100% in your stocks in just a few weeks. It could be a little bit slower going, but that's okay, because you catch a few of those big winners and you can still have your life changers in there. Just don't expect as many as maybe we had in 2020, and maybe to the degree.
Yeah, well, and I'll say, like, you brought the Fed and stuff like that. Now you're kind of seeing the effects of the Fed the other way, right? Where now the money, as you said, is coming out of the system.
Right.
Things could get bad, and there are plenty of people out there, really smart people, as Tom said last week, that are convinced that this market's going to go much lower, right? Things are going to get much worse, and they very well could be right. A lot of what they say makes a ton of sense. Like, this market could get really bad. But the reality is this market's gone down a lot already. The markets are always anticipating. They're always looking at 6 to 9 months. And so you want to be open-minded to the fact that, okay, yeah, it seems like the market is going to go down a lot lower just by the fundamentals, by the charts, all this kind of stuff. But what if we're at the lows right now or near the lows and we get that signal? What do I do? You have to kind of catch yourself, because a lot of times that's what I'm always like, I'll let these things influence me too much and get too negative, right? And then I'm a little slower to get back in. So you always have to kind of catch yourself, like, wait a minute, what if we get that signal? Can I shift and go against kind of the grain, where all the news out there is terrible, right? And the Fed is removing liquidity and rates are going through the roof, and no one's going to be able to afford anything, and companies can't, buy new things, right? It's terrible. But the markets are always looking 6 to 9 months ahead, and when the markets are ready to turn, they don't care. The markets do not care about the current news. It's always looking out ahead.
Yeah, and that mentality, it often gets the most negative, right before things turn around, or even things turn around sometimes and it's still very negative. You still have all those negative headlines, but at the same time, we see this so many times where some of the stocks that you're looking at, you might still be saying, well, no, this, the price is going down, but look at the earnings, look at the fundamentals, they're still so strong. And it's not until 6 months later that then you start getting the clobbering of the fundamentals, and it's like, oh, okay, the market really is a leading indicator, not a lagging indicator. So well, I think we can wrap it up right there. Any last words of advice here as we close this out, Irusha?
No, I the biggest thing is learn from this, right? There are plenty of lessons to learn from. I do not like doing post analysis, but I force myself to do it every year. And good or bad, you want to go back and learn, because this is a never-ending process of improvement. And if there are bad things, if there's been a bad year, we've all gone through it. The most important thing is learn from those mistakes so you don't have to go through it again.
Yeah, absolutely. I'm going to put Jared Tendler's little inchworm on there just for fun. So, okay, very good. When we come back, we're going to talk about a few of the stocks that look like they could be setting up, some of those relative strength leaders, and stay tuned. We'll be right back.
Peter Skoufis, founder of Skoufis Capital, has successfully managed money using Bill O'Neill's strategy for the last 17 years. Peter's missed major market crashes, such as the financial crisis of 2008, and most recently, the coronavirus crash of 2020. One of his strengths is finding new leadership in new market uptrends. If you would like to talk to Peter and get his thoughts on the current market and what to do now, or get a complimentary review of your portfolio, feel free to contact him at skoufiscapital.com. That's SKOUFIS Capital, CAPITAL.com. And fill out the contact form or by calling 866-562-2634. Protect your capital and don't miss the next market uptrend.
Okay, everybody, and welcome back to the Investing with IBD podcast, sponsored by Scoofus Capital Management. It's Justin Nielsen here, along with my weekly guest, Irusha Peiris, portfolio manager at O'Neill Global Advisors. And look who we got popping in. It's Jim Roppel from Growth Stock Mentor and Roppel Capital Management. So, Jim, of course, he's been a frequent guest of the podcast. You're going to be coming to our Founders Club event in Vegas this weekend, and we just got to hang out in New York. Which, by the way, thanks again for dinner. That was absolutely delicious.
Great.
Nice choice of restaurant and great company. So yeah, this has been a week filled with Jim for me. But hey, welcome back to the show.
Week filled of Justin.
So, Jim, let's go ahead and start out just kind of taking your broad view of the market. I mean, we've been talking about how much destruction has happened, but you have remained optimistic about, hey, look, the sun will come out tomorrow. Those chances to make money again, they're right around the corner. Do you think that today changes anything about your outlook because of the strong day that we had?
It changes a little. I mean, just a tiny little bit. I think to address the first part of what you said, the bull market really conditioned people to be overly optimistic. And this bear has conditioned them to be overly pessimistic.
Mm-hmm.
Just make no mistake, a massive, massive opportunity. Well, let me slow down. A big opportunity has already been created. If we have a third leg down, well, I'll probably only see 3 more bears this bad, 4 more in the rest of my life. It'll be a gargantuan opportunity. And, some of the names we can talk about, these new names that are going to jump out are going to be like a new Newbridge Networks or a new BlackBerry or whatever. I mean, as long as the golden goose of capitalism is suffocated by socialism, these names are going to come out. And we're getting a bit, if you go from the day the advanced decline line peaked in 21, we're in this pretty long.
Yeah.
Now, if we go from the absolute high, we might have a little more time. But would you wait 3 to 4? I mean, I don't know whether we're going to bottom in a week or 9 months, but I'll wait 9 months to get a shot at a double or a triple in my account.
Right.
Like, I'll take that all day long, every day.
Mm-hmm.
So don't let the market get you too bearish. And we can talk about a bunch of these names, but I'll tell you the mistake people are going to make. The market's going to have a follow-through day, and we're going to have a real one, unlike today, where 10 names come out that have TML characteristics. There's crazy good volume in the new names, not the old names. People are going to be super negative. They probably will skip buying them. The good ones will jump out, and the guys who do buy them will be so bruised from the bear that they're going to sell them up 10, 20%, and they're going to be the ones that are going to go like McAfee and Associates came out of a bear, went up 1,800%. Ascend went up almost 4,000%.
Mm-hmm.
So don't get too negative here.
And so how do you prevent yourself from getting too negative? Now, we can't listen to you every day. I mean, maybe we can. Maybe we should listen to you every day, because every
just
time
put
you
Jim
talk,
Roppel on
I'm like,
repeat,
let's
loop.
go, baby, yeah. But any suggestions on when people out there, where if they've gotten caught in this, and maybe you do need that third leg down to really get everyone bearish. What can people do just to try to fight their emotions?
Okay, you said the word, the E word, emotions. Okay, you have to objectively look at what happens after major bears. Okay, major bulls ensue, and why do so many brilliant people, geniuses, can't handle the market? Because their emotions get in the way. Strip that out, look at the facts. The first 15, 20 leaders to come out within a couple days before or the next 2 or 3 weeks after a follow-through day, after a major bear, are going to be generally most likely, odds very high, monsters. 100 to 400, 500. I mean, even greater percentages. So use the rules, follow the rules, and strip your emotions out. It's so easy to say that, right?
Yeah, right. Easier said than done.
Way easier. So you just follow the rules. Don't sell unless it violently breaks the 50-day, and ride that thing for all it's worth. Understand the total addressable market. Know the fundamentals cold, and say, well, if the market is $6.5 billion for the new ischemia thing for ShockWave, and they have like, $500,000 worth of market share right now. Yeah, I will sit through 4 massive pullbacks to the 50-day to try to capture that. Know history, and be ready, trim when things are excessive, and just know the rules, know the fundamentals, and sit as much as you possibly can, dampen volatility through hedging and trimming, and study history. Study Bill. Reread Bill's book right now while the market.
Yeah.
I think that's so key, because I mean, you were talking about Ascend, McAfee, and BlackBerry, which was called Research in Motion back in the day. The way that you kind of get that optimism, I think, is by just remembering how these came out, how bad the bear markets were that they came out of, and what it looked like afterwards. And I think you're absolutely right. Bill's book, How to Make Money in Stocks, the 4th edition, has 100 charts right in the first chapter. And it was something he had to fight the publisher for, because he's like, no, the publisher's like, who's going to want to start a book that starts with 100 charts in chapter 1?
I loved it.
Right, exactly. And they were like, yeah, your folks love it, but if we're trying to sell this, to real people, not the folks that are your diehards, how do we sell this? And he was insistent. But I think that's just such a great place to start and get that history, because remember, those charts, those 100 charts, start with Richmond and Danville from 1890, and include Tennessee coal and iron, one of the original Dow Jones Industrial Average components, and then just go on through what we ended with, like I think First Solar and Apple and a few of those, and Green Mountain Coffee Roasters in 2009 and stuff like that.
Yeah, well, it was those charts that in 2000 and 2002, when I got hit in that bear market, it was looking at charts like that kept the faith for me, because I had never really used the system in a bull market, and I still sometimes wonder why I even stuck around, because all I did was learn to cut losses really quickly, which turned out to be a great lesson to learn. But it was a lot of just looking at previous examples and going, wow, maybe I can catch the next AOL or Schwab.
Mm-hmm. So Jim, well, one thing I want to ask you, because when we were chatting in New York, we were talking about all of these leaders that were holding up pretty well, and then pretty much as soon as you left, like the leaders just got whacked. You jumped on a plane, and it was like the leaders said, okay, well, if Jim's going to be on a plane, we're just
going to tank him.
That's right. So what is your take now on some of those leaders? Like, you mentioned ShockWave, Enphase, Celsius, a lot of these names that a lot of us have been looking at got hit pretty hard last week. Are they broken, or is it just, hey, this is just the break that happens before even better things happen ahead?
Whether these names digest and move right ahead because we do get a real durable uptrend, or we have a third leg down and they get pounded, they've shown themselves. They were like those basketballs where they popped up in a kind of an okay moment, and whether we have the third leg down or not, I think they're going to probably lead in the next cycle. They might have to wait 3, 4, 5 months. I don't know. I think they will lead. At least I gave you like 3, 4, 5 of them. Probably
right.
3/4 of them will come back. But there's a big clue today. My volume percent gain list was chocked with junk, crap.
Okay.
And so it smacks more of a short covering rally, maybe an index driven. I mean, oh my God, the ECB quantitative easing, the first central bank to cave in. The end of we were deeply oversold. It's no shock. Any little, it's like throwing nitroglycerin on Tinder. We were so tightly wound that we had this big snapback, but you just can't have junk lead. There's a couple great names. Like I like Aspen Technology on a lot. How does this stock end up?
That's AZPN, right?
Yes.
Mm-hmm.
First Solar has held in really, really well where Enphase broke, which is odd because First Solar's earnings are nowhere near as good as Enphase's today, right. But the stock looks like it's prognosticating better things down the road. Eli Lilly came out today. but it closed very mid-range, right above the pivot by a tiny little bit. So it is questionable. They have two big drugs, but I would have liked to see that close a lot higher. But I'm disturbed by what ran today, and it smacks of another short covering rally. The great names, like I added a little bit. I bought it, guys. When I say I bought some, I bought like 1/100th of 1% of my account.
Okay.
I bought some. What did I buy? I bought a little bit of Lilly. I bought a little bit of Aspen. I bought a little First Solar, but it's just too. Look at KHYB. I have to beat this up. I mean, I want to be optimistic, but if you look at this, this is the high yield bond market in China, the junk market, commercial paper market, and it made a new low today.
Wow.
Okay. Now look at that. Look at 2020. That was when the world said that the global bond market and commercial paper markets ceased. They stopped functioning. Now, if that happened in 2020, what is this doing now? That's got to scare anybody. Now, no one is talking about this. But look at the yuan. It's been obliterated. I think it's well over $7 to the dollar now. Like there's major problems. You know, the pound was obliterated. Now the QE is now reoccurring in Europe again. The debt problem is it's not been solved at all. No one liquidated these Fed balance sheets, their central bank balance sheets. We did not have traction in leaders today. We may get it, we may not, but I will have to say, when the market turns up, the action in the leaders and the indexes will be obvious, but the news will be so bad, very few will be able to control their emotions and commit. And we're starting to get into that zone where it's super ugly. Like, is Russia going to use nukes? Who sabotaged the pipeline in the Baltic Sea? There's a border skirmish in other places in around Russia. Is Turkey got their whole naval force between Greece and, I mean, there's a lot going on geopolitically, financially. There's a lot of destruction. It's that kind of darkness that is going to be present when the market takes off and is discounting the future. So all these names I just gave you, I mean, look at Sanmina. It rallied up above the 50-day in a big bar, and volume came in the last like 30 minutes there, because I was looking at it, you know, midday, late in the afternoon, and the volume was low, but all the good names, the volume was pretty low across the board, which it's a little discouraging.
Yeah, so it really just you're still waiting, you're still watching and observing, building that watch list, maybe trying a little bit, but you're not getting that aggressive right now, right? The market, and we spoke about this a little bit in the previous segment, you know, the market is going to slowly pull you in when the time's right, and it'll keep pulling you in and keep pulling you in, right? And keep giving you more opportunities. And so you just have to trust the market and listen to the market.
100%. But I had a friend who's really savvy, and he texted me, he's like, the market's trying to pull me in today. He was like, I know it is. But there's a difference between starting a probe and getting traction and then building up. You know, like I could be long 30% on Friday, and I'm like one. I covered my short position. The remainder of that I closed out today. So I think it's more of a bounce-esque situation. But I have to tell you this. I listened to an institutional call today, and it was a technical analyst, and I don't want to say who, but he said, I'll take questions on any stock from anybody. Are you ready for these names? Meta, ARK, PayPal, Shopify, Coinbase, Moderna, Datadog, and SoFi. That is the biggest beat up crap list ever. Now, this is what people want to talk about.
Yeah.
Some institutions were on this call.
This was an institutional call. Yeah.
Well, they had a little bit of both, but I mean,
okay.
Like, what are they thinking about? Didn't they not read Bill's book? I mean, on the call, I was on another call with just a bunch of hedge fund managers, and one of them goes, well, if you're desperate to get in, you could buy the index. Like, anybody who's desperate to do anything, if you're desperate to meet the mate of your life, not happening. Desperation is code for FOMO and loser. And on the other call, the guy goes, well, you know, you could take a stab at this one. And then he goes, you could take a shot at this one. I don't stab at things. I don't take shots. I have the odds in my favor. I know history. The odds are, I'm the casino here. The other guys are the players on the other side of the table.
Right.
I don't take shots at things. That's a waste of your time. That's FOMO. And this is what some institutions are talking about. So,
well, I mean, hey, we're on our way to Vegas, so you're already talking casinos and everything. But I think to your point, one of the things that people have to realize is, they think that, okay, some of these things that are setting up potentially, if you still have that market weight going against you, a lot of times you're not going to get the big gains out of it. It's just, that market overhang is just too much of a headwind a lot of times. And I always think back to what Charles has said numerous times. Charles Harris, who I really respect. I mean, he said, you know what, I'm so good in bear markets picking the winners. The problem is I pick all the losers too, and I don't make any progress, or, the winners, I mean, they just aren't enough to overcome the amount of losers there are.
Well, they're not only that, the volatility that's entailed to deal with a big winner in a bear is too hard. The pullbacks are too brutal, and the overhead, like you could look at Netflix today. It has, if you took the left-hand side of the base out and just looked at the price and volume, look at the up move. About 5 weeks ago, a big bunch of blue volume bars came in.
Yeah.
And then about a week ago, a bunch more came in, and then volume came in today. But you look at that gap down, and that, how far off the high is it? Like 50, 60, 70%?
Let's see, 65%. So
why would you fight that? You could buy a Yugo or a Lamborghini. Why would you buy the Yugo? This is the Yugo. And Justin, everything you said, all the MAs are pointing down. This is just like the index.
Yeah.
Why fight it? You could buy Aspen or First Solar or, Sanmina or REGN looks great. And Vertex looks very interesting. And then the monster of monsters today, Biogen, BIIB, Alzheimer's drug was approved today, I believe. Is that right?
Yeah. So or not approved. I think it had a positive phase 3 trial, and that was also helping Lilly.
Look at the volume percentage change.
Massive.
Now, I guess, one of the things that bothered me a little bit about Biogen is it's had a lot of these big weeks before. You just go back a little ways, huge volume, huge week, didn't go anywhere. A few months before that, huge volume, huge week, didn't go anywhere. So do you think this is the one that's for real?
It's worth the risk. Okay, that type of institutional demand is so rare. If this goes dead tight, or maybe it inches a little bit higher and then goes dead tight and gives nothing back, I mean, it's one of my key variables. Volume explosion gap up is a buy. They're super rare. And if you get stopped out and you lose 1 or 2% or 5% on this thing, you lose 0.25% of your account on it, super worth the possibilities. I mean, the market for this is so gargantuan. You have a very legit point. There is overhead still, but look at the volume. And I see what's happened in the past. I bought the last big gap up. I remember I was coming home from golfing in California, and that I bought it at the airport. I'm getting on a plane. It's worth, the answer is, I give you a 20-minute answer. It's worth the risk. I didn't buy it, but I kind of feel like some of the ones I did buy didn't have the volume, and this one did, and I didn't buy it.
Yeah. Well, I would say about I would say it's worth the risk if you manage the risk, right?
Yes.
So at that, when you manage the risk, it gives you a little bit more flexibility to try different things and push it a little bit when things are lining up. But Jim, I'm sure if it's going against you, you're out. So maybe if you're on the plane, you're getting a few days later when it's going back against you, you were out, not even thinking about it. You're just following that plan.
In seconds, I was out. I mean, I got out very quickly after that other one. I mean, dude, I don't ever, if possible, it's not a gap down. I cut all my losses at 357, 345. I'm just out. No patience for losers, and my position is so small. I mean, there's follow through days in bear markets, and there's follow through days in pullbacks in bull markets, and you have to adjust your position size to the environment. I mean, is it an irrational exuberance moment? Or are we in a horrible bear market, like one of the worst we've seen? The percentage stocks in bull mode is in the single digits.
Yeah.
These are low. These are levels we haven't seen in a very long time. This is a once in every 10, 15. Well, we had 2 once in a generation bears.
Right.
Yeah, I was told once in a lifetime.
Yeah.
A number of times in my lifetime so far.
Well, we've had a couple 100-year floods. I don't know if you're
Yes.
watching what's going on in Naples right now.
Yeah.
Oh
seriously.
yeah. Well, so I mean, you've given us a lot of food for thought here. Any kind of closing words on some of these stocks? So I think, some of the keys that you're talking about here: volume, huge. Something that was a little amiss today, and some of the names that were looking the best just didn't have that volume confirmation. Other things that people should be looking at. You mentioned the fundamentals. Looking into that total addressable market, and something like Biogen with Alzheimer's, of course. I mean, that's a huge deal. Relative strength. Anything else that you kind of say, hey, here's how the leader's going to smack you in the face if you're looking at these things?
Well, because quantitative easing has ended, volume is probably going to be a lot more relevant, and price discovery in markets is probably going to be more pure. So you can hopefully pay attention to that more and get more confidence from it. But the onus here is on the bulls. The bears are completely in charge. The follow through day today, well, I don't even know if we really had one. It's maybe on NASDAQ you did. It's a debate. We'll sort it out.
Yeah.
We were debating it earlier on this episode. But
Okay, you did already talk about it?
well, we said it's not a falter day because
Okay.
we were not calling that 4 days ago the pink rally day. It wasn't big enough for a pink rally day. So it's day number
Because
2.
of the gap down. Yeah.
Okay. But if let's say it was,
Right.
That tells you that the possibility exists that an uptrend has started, maybe.
Right.
If it's not corroborated by 5 to 10 to 15 fresh breakouts in the reasonable period of time, if look, the MAs are all 3 going straight down, or is the 50 kind of leveled off? I mean, we got to get
no, that's still kind of turned down.
I mean, the new lows are drowning new highs. There's
Absolutely.
so many things that have to change, and I would rather be late and have confidence in durability than early and wrong again. I mean, if you lose 1% of your account and there's 10 failed follow-through days, you can do your math here, okay? And most people are not going to get out with a 1% loss of equity. They're going to lose more. So I hope I gave you a couple answers. I don't know.
Yeah, no, that was kind of our lesson of the day. You have to be careful of that chop, the death of 1,000 cuts. I'm going in a little bit, and even if you're cutting your losses quickly, if you're just doing it too much, or you're getting too much size too quickly, and taking the 4%, 5% loss, I mean, that adds up. And before long, you've got a ton of losses, and you're looking at a portfolio that's quite a bit smaller.
I think you do. Let's say you had 10 failed follow-through days in a row. I was on the phone with Bill. Bill called me. He's like, "What did you buy today?" I go, "Bill, everything looks terrible." He goes, "You go buy Bristol Myers and Skechers or something, like Wells Fargo." He's like, "You have to buy something." And so if you get into a position where we're going to follow through and I'm not going to buy anything, then you're going to have a problem. Because if you even bought just 100 or 1,000, whatever your minimum position is, and you get a little traction, then you follow up and keep following up. But if you just go, "No, I've been stopped out in 5 FTDs in a row, I'm not going," that's it. You call me and let me know.
Right. No, I mean the one in July, and we were talking about this, Justin, right? Both of us didn't buy on that fall today because we were distracted and stuff like that. And we were talking about, like, oh my God, we're not in it. And of course, that's the one that worked, right? So you always have to, just like Bill said, and just like you said, Jim, you have to buy something on that follow through day when you get it, just to get a little bit of exposure and feedback from the market.
Well, hey, Jim, I got to just thank you so much for coming on the show again. It's great to see you. I'll be seeing you in a couple of days. We'll both be seeing you in a couple of days at the Founders Club. So can't wait to see you in Vegas.
And check out growthstockmentor.com too. Right?
Oh, yeah. Absolutely. Okay. Thanks a lot, Jim. And thanks again for showing up. So on the That's going to wrap it up for us today. And on the show next week, we're going to have Tom Dorsey on, talk about one of those legends in the field. So I don't know if we're going to get into point and figure charts, but can't wait to hear what Dorsey's take on the market is. And thanks a lot for watching us today. Take care. Make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.